Hey everyone, welcome back to the Daily Gold Podcast. I'm here and today we're talking with a company called Tradewinds. The symbol is TWD on the Venture Exchange, and I'm talking to the president and CEO, Ian Lambert. Ian, as we get started here, can you tell us about, maybe give us a little background on Tradewinds, yourself and the other key players involved, and maybe how you came across your flagship asset, the Block A project at Detour Lake?
Certainly, Jordan. Tradewinds got involved in a joint venture option agreement with the original landowner, a company called Palangio Mines, back in 2003 when we entered into an option to earn 50% interest on this Block A, which was at the site of the former Placer Dome mine located at Detour Lake. We certainly did quite a lot of drilling in the first few years and earned our interest by 2006, having spent over $7.5 million on that property. At the beginning of 2007, Palangio sold their position at Detour Lake, including their 50% interest in Block A, to a company called Detour Gold, which was formed to take the Palangio assets through to production. Detour Gold has done extremely well and is now well-funded and in the final stages of development and construction to put the property directly adjacent to the east of ours into production by the beginning of 2013. This is a over $1.2 billion project, so it's a very significant operation with almost 15 million ounces of resource at this point in time, or reserves actually. And right next door to it on Block A, we see the mineralized trend that goes through these properties continuing across Block A, which we are the operator of.
Now, Ian, maybe you could talk about Block A as far as what the current resource count is, because it looks very significant to me relative to the size of your company and also the growth potential of the resource.
Right. Well, based on around 120,000 meters of drilling that we had done up till the beginning of this year, we published a resource in February of 2011 that contained two sets of numbers, and I don't want to confuse you, but I will try to explain it. One is the set of numbers that's generated by the block model that looks at all mineralization, doesn't consider economic recovery. It just says that either the block is mineralized or it's not based on drilling. The total resource from 500 meters to surface, because we're focused now on an open pit potential, is 4.4 million ounces on Block A. In addition, Tradewinds has another 235,000 ounces on the next westward property called Go West. So that's a total of 4.65 million ounces on the properties we're operating. Now, within that, as a subset, if you like, is an economic pit shell that's been developed by the engineers that looks at the potential to recover and produce gold from all of this total resource that would be economic at $1,000 gold. We used a $1,000 cutoff at the time in order to be conservative, even though the price of gold is considerably higher. And we also used a 0.4 gram cutoff grade on this large open pit project. The total resource that was in the pit shell was 2.686 million ounces. And that is the number that we're working on at this point in time and expanding through the drilling program that's being done in 2011 and will continue next year and the year after.
And correct me if I'm wrong, but I believe the next resource estimate is going to come out, is it going to be this fall or in the coming winter?
It'll be in the coming winter of 2012. This year, in 2011, we've completed a 30,000-meter drill program already by the middle of part of the year. We've engaged on the second half program, which is another 20,000 meters of drilling. And in addition, we have almost 10,000 meters of previously drilled core that hadn't been sampled. So at the end of the year, we'll have a total of approximately 60,000 meters of drill core to process and put those assay results into a block model update that would happen after the year end when all the results are back. And then we would run another engineered pit model to see what size the pit is at that point in time. Now, note that the amount of drilling that we're doing in 2011 is almost 50% of everything we've done to this point in time. So it's going to be a significant increase in terms of the amount of data, and we anticipate in terms of the number of ounces as well.
And Ian, maybe you could discuss with us some of the advantages of the property, maybe the infrastructure, the fact that you have a large partner that's basically sitting right there next to you with their deposit.
Certainly. We're certainly well located because we have road access, and that makes it way different from something like the Ring of Fire where you have to spend a lot of money just physically getting there. Everything can be driven to the site, including our personnel. We're about an hour and a half from the nearest town, and of course we're right next door to the huge development that's being done by Detour Gold. So Detour Gold is building their operation and expanding the infrastructure. They're bringing in the power, and the whole area is getting developed and is focused on becoming a mining complex. So we're part of what is going to be the largest mining camp in Canada for a gold operation. And, so it's a pretty significant development, and we're right smack dab in the middle of this whole thing.
Now, I don't know if you saw it, but I read an analyst report where it actually discussed that with Detour going into production, that actually if they took some ore from your open pit, that it could actually benefit their operation.
Well, everybody's got their thoughts on that, and I'm not going to say that that's the case or not, because you'd have to actually do an engineering study to confirm that. What we do know is that on Block A, we're looking at two directions for us. One is to build a standalone and separate mill from the one Detour is building about 3 or 4 kilometers away. And the other alternative is Detour has already announced that they're looking at expanding their mill. And if they were to expand their mill, they may well look to Block A to be providing some of the source for that expanded throughput. So those are two of the directions that we're evaluating for Block A mineralization that could be processed in either direction. And we will probably determine better how that will go when we undertake a preliminary economic assessment plan for the first half of 2012.
Okay, now as far as let's just get back to the resource and the resource number. Assuming you guys have a material increase in the resource estimate, do you believe that, given that you increase the resource, over a certain number to a certain level, that the market would then value the resource at a higher level just because it's becoming so significant?
Well, I think that that's a likelihood that we could reasonably expect. As you advance a property more and more to a point where people get the evidence that you're going to be actually able to put this thing into production, then they're going to give it a higher value than if it's just a random small deposit that may or may not ever make it. Now, I think that the completion of the preliminary economic assessment next year that would confirm that this is a viable operation would be a significant advancement for us in terms of our valuation. So we hope that the incremental resource that we are doing and the new results we expect to get in our second half drilling, we expect that those will be similar to the ones we've been getting all year long, which are all very good. That the resource update will be significant, and that alone should stimulate the market. And then we believe that the PEA following that should even more confirm the advanced stage of this project and the fact that it's really worth a lot more than it's currently being valued for.
Right. Well, it seems to me that the market is already noticing, given that the stock has recovered nicely and it's performing very well relative to its peer group. Now, Ian, as we close here, is there anything else you want to add that we didn't discuss?
No, not really, other than to point out the fact that we believe that when you compare the value of per ounce in the ground of our asset and you compare it to the more advanced stage peer group, we're trading in the $20 range per ounce of the ground, and so many of them are trading in the $50 to $70 range. So there's really a lot of upside for an investor on our stock just on what we have already found to this point in time. And of course, there's a big upside we see in terms of expanding and adding new ounces to the overall pit as we advance it towards production.
Okay, Ian, thanks so much for your time and your insight today. I really appreciate it.
Thanks for having me on, and hopefully we can do an update when we've got some more results.
Absolutely. Thanks, Ian.
Okay.